Hey there, everyone. Dave Keller with Market Misbehavior here, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, talk to them about their process, their perspective, their experiences, their outlook. And it's been such a pleasure to sit down with money managers, analysts, strategists, traders, brokers, authors, educators, anyone I can find to interview and pick their brains about market conditions and how they're approaching this volatile market environment here in 2025. I'm super excited to share this conversation with you. I sat down here earlier with John Roque. John is the head of technical analysis at 22V Research. I first met John back in the day when he was on the sell side at Natixis Bleichroder. He would come up to Fidelity, and I got to know him on quarterly visits up to Fidelity, where I just absolutely enjoyed every minute of those meetings. What you'll find, I think, very quickly from the conversation, John speaks very simply and very straightforward, and every one of his comments reflects an incredible wealth of experience and investment knowledge behind the scenes. He's worked with some top investors, from working at Tudor Investments, working at other hedge funds, working on the sell side, now more recently working in the independent research community with people like Ed Wolf at Wolf Research, Dennis DeBuscher and others, former ISI team, now at 22V Research. I was able to ask John about one of my favorite analogies, the baseball analogy, one that I share to this day in presentations when I'm trying to explain why relative strength is so important. So after thanking John for that great analogy that he provided years ago, we talk about the importance of relative strength, which is a core part of how I approach the markets, trying to assess how different stocks and ETFs are performing relative to one another, why that is an important data point to reflect on relative to the absolute performance. And we looked at utilities and talked about some other examples of where that is so valuable. We talked about combining technical analysis with the macro environment, talked about the changes in the financial industry over the years and how his approach to technical analysis has actually been simplified over time. From early in his career, looking at a lot more indicators, to now simplifying and look at basic measures of trend and momentum. We talked about the recent market volatility, and I really appreciated John's summarization or summaries of what has happened in 2025 from the peak in February, the signs going into that peak, the low that we saw in early April, and what signs suggested a tradable low in his work, and where we're at now as the S&P and the NASDAQ are rotating back up toward their 200-day moving averages. So if you're struggling to make sense of the markets in this kind of environment or any kind of environment, I often found sitting down with John and getting the opportunity to pick his brains to be a very therapeutic and information-packed discussion, and this particular discussion was no different. So please enjoy this conversation with someone who I consider one of my mentors in the technical analysis community, John Roque of 22V Research. So super excited to be sitting down today with John Roque of 22V Research. John, I first followed your work years ago, and it's been so fun to sort of follow along with your journey over the years, but I'm super excited to catch up with you today. Thanks for giving us some time.
Thanks for having me, Dave. Always a pleasure to see you. I'm sorry that we don't see each other as often as we used to, but the reconnection is most welcome.
Life happens, and we're on opposite corners of the country these days. So hopefully that we at some point can get together in person. I look forward to it. So John, listen, I have to start off. I'd love to talk a little bit about your background. You've had a really cool experience in the financial industry, working with some top firms and some really successful people. And I'm excited to sort of pick your brain on some lessons learned along the way. But I have to start with one of my favorite analogies that to this day I share often in presentations, and it came from a meeting you had in my Fidelity days. You came up to Boston from New York, and I'm sure you don't remember this, but let me remind it. And then
Please.
There's a question at the end. You gave this great baseball analogy, and you came up to this room full of Red Sox fans in Boston and said, "Let's pretend you're the manager of the Red Sox, and the Yankees are coming in town. Who do you want to put on the field to give yourself the best chance to win? Your players that are struggling, that aren't hitting well, that aren't fielding well, or your top players at the top of their game? Why would you do anything else with your portfolio?" And I continue to share that story, which resonates with anyone that's ever heard of baseball. So starting off, Thank you for that analogy, which is
You're
just
welcome.
brilliant. I mean, I appreciate you so much introducing me
Thank you.
to that way
You're
of
welcome.
thinking of portfolio management. Well done.
Thanks.
So talk to me about this. I mean, along the way between when I got started in the industry and then years meeting you and getting to know you and your work, I really started to appreciate the value of relative strength, which is what you're alluding to in that analogy. Can you talk a little bit about why relative strength matters, how it fits into your process of just understanding strength and weakness in the markets?
Okay. Well, thanks for the very kind introduction. Again, thanks for having me. Pleasure to be with you. So I like to look at relative strength, and really, it's just, for example, me against you, right? There has to be
Mhm.
some sort of a benchmark. And, I might think I'm good on an absolute basis, but compared to you, I might not be good. And I think that's the way to think about, stocks. We do it because we need some comparison. And
Mhm.
very often it was true in the past. It hasn't been true for a long time, that you wanted to look at the S&P versus bonds, right? That was kind of the industry-wide benchmark, because depending on the economic cycle, where did you want to be? Did you want to be in stocks or did you want to be in bonds? And then, of
Yeah.
course, you could take a stock versus its own index. You could take NVIDIA versus the semiconductor index. You could take Schlumberger versus the XLE if you'd like, or et cetera, and anything you like. And I think relative is important because it provides some clues. Now, in a
Mhm.
bull market, if you're winning on an absolute basis and you're winning on a relative basis, well, you've really only had to make one decision. But if it's in a
Mhm.
more difficult environment, the relative line really kind of does give you a lifeline, so to speak, to hang on to. You might say, listen, I know this stock is coming in. It hasn't served me well on an absolute basis, but relative to my benchmark, it's holding in here pretty well, which suggests to me that other investors find some value in owning it. Now, I'm going to
Mhm.
give a real life example right now. The XLU, or the utility sector, has held up pretty darn well in the face of what has been some pretty poor market action since December. Now, we might say, well, John, the only reason it's held up is because there has been some pretty poor market action. And I'm going to say, yeah, that's a pretty decent point. But the XLU here, which Dave, you're showing, quickly moved below its upward sloping 200-day moving average and then recaptured it. So there's really a bigger message here among the utilities that I don't think, I'm talking about myself, I appreciate yet. Meaning that
Mhm.
there's something bigger happening here for utilities that I'm not certain is well distributed. So the relative, and in the bottom panel, you could see the relative has come off of late because the S&P has rallied 15% in 3 weeks. And of
Yeah.
course, the XLU has not. But be that as it may, this kept me in the game while the S&P was faltering. And it gave me a chance to say, is there something more important going on here? So I think there are often bigger messages in the relative line than just, well, I might be outperforming here.
Ooh, I love that, right? And I think a lot of people probably think oversimplistically about the relative performance, right? It's sort of your report card. But one thing I've learned from talking with you and others over the years, there's information there, and you're
Right.
sort of alluding to the questions it empowers you to ask, right? Is sort of thinking about what's causing some of those movements.
Yeah,
I want
and
to come
and and
back,
I think
John. You go ahead.
pardon me, as technical guys, I mean, we don't know, but we know that there's a message there. And so if I'm speaking to Dave Keller, manager of a utility fund, I'd say, listen, Dave, I mean, not only are your guys giving a message on an absolute basis, but they're giving it on a relative basis. What's changing in this industry?
Yeah.
Is something changing that I certainly am not aware of? And politely, and I'm not being a wise guy, are you aware of it? Because they're saying something that I don't think is well distributed yet.
I want to get back to the current market environment because obviously a lot of things happening just in the last couple weeks. I feel like the world is changing rapidly. So I'd love to just get your sense of how you're navigating this. But talk to us a little bit about process and certainly about your evolution, right? I mean, when I first met you, you were on sort of traditional sell side shop. It was Natixis, right? In New
Yes,
York.
that's correct.
And then after there, you went to a series of hedge funds, right?
Yeah.
What was it?
So after, so it was Arnhold and S. Bleichroder. Then they were
Yeah.
bought by Natixis Bank in France, and then they combined with another French bank named Ixis. So I'd like to say that we had a vowel movement. We went from Natixis Bleichroder to Natixis Bleichroder. And then I left there, went to a small shop for a little while, and then had the good fortune to join Soros Fund Management.
Yeah.
In 2012, I was there for 4 years. I worked for the current Treasury Secretary, Scott Bessent. And then Scott Bessent and maybe 6 or 7 people left Soros at the same time to go to another firm called Key Square Capital Management, where Scott Bessent was the CIO there again.
Right.
So I spent 7 years on what is called the buy side. And what I found over time, Dave, at least it's true for me, is that when I got into business, I tried to learn every indicator. Bloomberg's were not well distributed, so I had to create the math in an Excel spreadsheet so that I could create my own MACDs or my own stochastics or my own RSI.
Right.
And I tried to maintain or keep, as the language used to be in our business, how many indicators do you keep? I used to keep a lot of them, and I found over time, and I'm just speaking about myself, that I do a better job when I reduce the number of things I'm paying attention to and try to keep it as simple as possible. And that's kind of the stage of where I'm at now. I really have tried to narrow my focus and say, I'm really going to concentrate on these items because I think I understand them better than other items. And it's easier for me to explain them rather than bringing in other things that I just don't work closely with, or then will do a poor job explaining them.
Oh, that's so well put. And I so early in my career, I was taught technical analysis. Same idea. That was given as a mentor of mine gave that as my homework, was prove out RSI and show me in Excel that you know how it's calculated. And then we went through a bunch of them. And I thought that was really helpful. But in the end, at the end of going through a bunch of these, I felt like I had way too many things to try to follow.
Yeah.
And I found myself simplifying. Was that rotation from the sell side to the buy side, where your goal is not as much to, tell stories and provide context and to generate returns? Was the need to simplify a part of that transition to just trying to come up with a conclusion, or was it, how would you think about that?
I think that crystallized the notion that, I was on that trajectory anyway. But when I got there, and I'll tell you, my first day sitting on the buy side, I was used to making phone calls to the Dave Kellers of the world and saying, Dave, this is what I'm seeing.
Yeah.
And all of a sudden I'm sitting at my desk and I said to myself, man, this is weird. People are calling me now. And I found out quickly, I think it took me half a day, where I said to myself, this is really a different environment. You better move your feet and, be active either on offense or on defense, because this is a different environment. And then I actually approached it as if I was a sell-side analyst inside a buy-side shop, meaning that each of the PMs who had a different raison d'etre, some were doing, sovereign debt, some were doing commodities, some were doing currencies, etc., is that I tried to be a sell-side analyst to them in their different disciplines. So I was kind of doing the same job. It's just that I was under the imprimatur of one umbrella, and but I had many clients within that umbrella, and some were doing equities, some were doing bonds, some were doing equities in Hong Kong, some were doing equities in the UK. And so I was able to kind of fix my mindset by just saying, okay, you're now on the buy side, but keep operating like a sell side analyst and keep hustling. So but the notion of keeping it simple was crystallized there.
Yeah. No, that makes a ton of sense. And I love that way of thinking about your role there for sure. So after a successful stint sort of in the hedge fund community, back to now sort of independent research, right? You worked with Ed Wolf at Wolf Research for a while.
When I worked with Ed Wolf for a while, and then the opportunity came to join 22V in the summer, early autumn of 2021. And it's a macro shop. And I thought it was a good opportunity for me. And the people that I'm working with are good people, and it's a nice firm. And I think the platform is good. I had a colleague when I was at Soros Fund Management who made hats for everybody where it said, make macro great again. And when I got to 22V, I had those same hats made up for myself and my colleagues. And I think it's true. We're trying to make macro great again. I think there's some great insights and information that perhaps some of us are not readily paying attention to. And I think, the market is just one giant mosaic.
Yep.
And I'm not saying that all items are correlated with other items, but I'm saying that you have to notice them, because even if they're not correlated, you're missing profit opportunities if you don't notice them.
Yeah. So now you're at the shop 22V, and again, it's was started with a group of ex ISI
Correct.
people, right? People worked with Ed Hyman, famous
That's right.
investor at ISI. And so, you're a technical analyst at a macro shop, looking at a lot of different macro inputs. Can you talk a little bit more about that relationship between what you're seeing on the charts and what others at your firm would be seeing through other disciplines? And how do you triangulate good or bad charts versus this macro environment? How does that how do you combine that, or I guess weight those different parts of the mosaic day to day?
Okay, that's a good question. So I have come to the realization through market scars that it is harmful to my performance or the performance of a portfolio if we need agreement. And I'll explain it as follows. So I've used this example before. So Dave, if you've heard it, I won't be offended if you stop me. Here goes. So Dave Keller, John Roque start in the business on the exact same date. We'll just say it's 1994. And our mentor hires us, or our boss hires us, and he says to both of us, keep your mouth shut, keep your eyes and ears and your notebook open, because I'm going to drop pearls on you as long as you're sitting next to me. And we follow his lessons, and every day we are taking notes and we are listening, like eager puppies, for the day's treat.
Yeah.
And we sit and wag our tail when appropriate, and, we bound ahead when appropriate. And after about 6 or 9 months, our boss comes in and he says, Dave, what'd you notice? And Dave eagerly says, I noticed A, boss. On my charts, A is happening. And he said, very good. I noticed that too. Says, John, what about you? And I shot my hand up and I said, boss, and I noticed B. And here's what's going on with B. And he said, very good job. Dave, you noticed A. John, you noticed B. Boys, what are we supposed to do? And in unison, we yell out, we're supposed to buy C. And he said, very good, grasshoppers. You've learned your lesson. I don't think that's the way the business operates anymore.
Yeah.
I think the business operates by, if you see A, you better do A. If you see B, you better do B. C might never arrive. In fact, F might arrive. G might arrive. Z might arrive.
Yeah.
And the reason I believe that is because there is no algo programmed in the entire world to know about the relationships between different asset classes.
Yeah.
Now, they have a decision tree that might be 100 items long or big, or 1,000 items. Our decision tree might have 5 or so items. If one of them gets shut out, we've got to go back to the drawing board. If one of the items on the decision tree of the algo gets shut out, they just move to the 990th version.
Yeah. Yeah.
And so, we might say, oh, that doesn't make any sense to me. It doesn't make any sense, but I don't know that algos have to know that it makes sense. So that's why I know the rules. That's what the gray hair's from. You know the rules. That's what the scars are from. But I don't necessarily know that they are always applicable in this environment.
Yeah.
So, that's only come because I've made mistakes, not because I got so many right. It's because I said to myself, well, this should have happened. Why didn't it? And then I said, I should be just approaching these things, without necessarily correlating them.
I love it. And what I love about what you just described there, John, is it's focusing on the evidence, focusing on what you're seeing, focusing on how that changes. And when the picture changes, you have to acknowledge it, right? And you have to react. You have to evolve, for sure. When you're analyzing the markets here in 2025, and again, I mean, so much has changed structurally, but what resonates to you in terms of what you are trying to do as an analyst of understanding the markets? How has that evolved from now to previous points in your career? I guess, what's different now and what's challenging when you're reviewing the current conditions?
What's different is that there is an awful lot of good technical commentary or news found on X.
Yeah.
That didn't exist in prior cycles.
It was non-existent, right?
Yeah. That didn't exist. There's a lot of good stuff. I mean, I'm not surprised. I am glad that there is so much good stuff. My my education via FinTwit, I think, has just gotten better. Number two is that it's hard for us to put as much evidence or put as much weight on historical indicators, because every one of those indicators was developed when there were traders on the floor of an exchange.
Yeah.
Every one of them.
Yep.
So I don't know that any algo or passive instrument is programmed to know what an overbought MACD is supposed to mean, or what it used to mean. I don't know that they know how long a negative divergence is supposed to persist, or whether they even notice it. So I think these things are changes that we have to be aware of. Negative divergences can persist for a long time.
Sure.
We keep railing at them or yelling at the screen or yelling at the chart and wondering when this is going to matter. And the real answer is nobody knows.
Yeah.
You just have to keep looking. So I think those changes are important. And I think because there have been so many of those important changes, I think it actually has made me feel better about narrowing my focus on what I am looking at. Because I'll tell you, I think more than ever, monthly charts are more important than they may have ever been, because the dailies have just so much volatility in them.
Yeah.
So I was taught many years ago, I'm sure you were taught the same thing. The dailies feed the weeklies feed the monthlies.
Sure.
The monthlies provide the most important signals.
Yeah.
And so I think I might do a better job if I did my job Friday at 4 p.m. because I'd get the correct weekly prints rather than trying to figure out Monday through Friday in the daily volatility or vagaries of the market. So I'm really keen on long-term charts, and I'm very keen on trend. I think that the trend bails you out even when your timing is poor. And I am just trying to keep it as simple as possible. I will emphasize, and I tell myself this every single day, I'm no trader. I think I'm a trender.
I like that. I'm no trader. I think I'm a trender. That's fantastic, John. I love that. So I would say probably anyone watching or listening to our discussion here is probably desperate for some sort of context, given the noise, given the volatility, given the severe movements we've experienced just in the last, couple hours, forget about the last couple months. So, we look at the S&P or the NASDAQ, we've had a significant peak in February. We have what may be a significant peak or at least a significant low, or at least a low in early April. And now we're sort of trending up back toward the 200-day moving averages. When you take a step back and look at the, U.S. equity markets, I mean, what is your general sense? Are you finding at this particular time more reasons to be optimistic, more reasons to be pessimistic, somewhere in the middle? What is the evidence telling you as you're trying to take a step back?
Okay, thanks. So I will tell you that the market internals that I do pay attention to started to deteriorate in December.
Yeah.
That's when they really peaked. And then they kind of had lower highs in February as the S&P was making a new all-time high. And I didn't think that that was going to be able to last. And so my downside target was first 5,500 and then 4,800 on the S&P. And we got pretty close to 4,800.
Yeah.
And then shortly after the low, I sent a note out to clients entitled, "Yes, We Can," which is a song from the early 70s by the Pointer Sisters. And I thought it was, "Yes, we can rally."
Yeah.
And I thought that we could get to about 5,500, 5,600. Now, I'll tell you, and whoever might be listening, that in early April, we did get internal bear market low figures.
Yeah.
We saw 2 days on the New York Stock Exchange with more than 1,000 new lows, and we saw 5 days on NASDAQ with more than 1,000 new lows. Those are consistent with bear market low figures. We also had very low readings comparable to prior bear market lows for percentage of stocks above their 200-day moving averages. So that's why I said, yes, we can. And then maybe a week or two ago, I sent out a note using a song from The Cure entitled "In Between Days." And I thought that the market was kind of in between days now. We had made a low, we had rallied sharply, and I wasn't really confident that there was a lot left in the rally, especially since, as you said, we're coming into a cresting 200-day moving average.
Yeah.
Now, you know it as well as I do, there were 15 bear market rallies from the peak in 2000 through the 02, 03 low for NASDAQ. There were 5 or 6 bear market rallies during the GFC for the S&P 500. Right now, I think this is a bear market rally. If I'm wrong, I'll say I'm wrong. I mean, that's the price of doing business in the market. But
Yeah.
I mean, it's hard for me to get aggressive up 15% in 3 weeks into the prospect of a cresting 200-day moving average. So it might be that we pull back. Maybe we pull back and hold at 5,400. The data doesn't get any worse. In fact, you'll start to see, positive momentum divergences develop. So maybe that's what we'll do. But I'm reluctant to kind of get aggressive here, especially since we're up 15, 16% off the lows in what is really 3 weeks.
I mean, and I've often told people bear market rallies are sudden, swift, and seductive, right? They come out of nowhere. They're incredibly rapid, and they draw everyone in so quickly. So one final question then. I mean, talk to me a little bit about leadership, because we started with the chart of utilities, right? It's telling to me that that's a really good way of demonstrating a sector that's had pretty decent relative performance year to date. I mean, down a little bit in the last week, but overall pretty good. Now we're in a week earnings wise. You have like Meta, Microsoft kind of names gapping higher, and a lot of technology having a nice run off of the April lows. How much is leadership going forward important to telling the story of what's going to happen next, right? How do you look at the types of names that are working or not, and how that overlaps with this sort of maybe bear market rally thesis as you described?
Okay, thanks. So into the low, the worst performing sectors were tech and consumer discretionary.
Yeah.
Which is really just tech light.
Yep.
And, tech is now the best performing sector off the low.
Yeah.
So that's regular business, which is, okay, fine. Nobody had them as the worst performing sector. But of course, them being the best performing sector is business as usual.
Yep.
So I'm going to say that I'm going to offer an idea here. I think a clear way, not easy, but clear way to try to figure out what environment we were going to be in is if you take the XLI, which is the industrials ETF, and you divide it by the XLK, which is the tech ETF.
Okay.
Now, of course, it is rare for the industrial group to outperform tech. So I would say that if you had this relative ratio and the relative result, crafts a low here and turns up, then I think we would be in an environment where, let's call it just value or non-growth, will be outperforming growth. And if the XLK, if this relative ratio XLI over XLK turns lower and makes a new low, then any idea about a value or non-growth outperforming growth trade is out the window.
Interesting. I love that idea. So, and again, and John, I have to thank you. I mean, I've learned so much from conversations with you over the years, and this is no different. So, looking at the ratio of the two and looking at that relative movement. So people often think simplistically about relative strength. That's a stock or ETF versus the benchmark. Let's also look at relationships between different things, growth versus value, and using that to assess leadership. I think that's really well said. John, listen, this is so much fun. This reminds me of really fun conversations we used to have in Boston and New York. And I'm so thankful that I had those informative years of my own.
Thank you. Thanks for being
glad to keep in touch with you
a kind host to me when I used to visit you in Boston. And thank you for being a kind host to me now. Always a pleasure to speak with you. Pleasure to know you. And just great to be with you. Thank you.
Appreciate it, John. Listen, all the best at 22V. Keep up the great work, and we'll look forward to continuing the conversation. All right, bye now.
Thank you.
It was a lot of fun. Again, the moment I started talking with John, it immediately took me back to conference rooms in Boston and just enjoying so much, especially in a crazy volatile environment, getting to sit down with John and just talk about market conditions, talk about what he was seeing, just reflecting on what had changed and what was looking good and what was not. Just remembering the value of simply looking at the evidence and analyzing trend. I think, as he said, I'm not much of a trader. I'm more of a trender, and I love that way of just recognizing that the evidence of the markets is what often is so important to follow on. I think his recap of 2025 and just talking about how the conditions changed from 1 week, from 1 month to the next. Really valuable, and thinking about timeframes, right? Again, I mean, so many of the people I've talked to, and John the same, reflecting on, given the volatility in the markets, instead of focusing more closely on day-to-day market movements, the solution is take a step back, right? When in doubt, zoom out and reflect on changes week to week, month to month. And that's what I was able to learn from John over the years. And again, this conversation. That was a lot of fun. Great to reconnect with John. I hope I'll be able to get together with him in the New York area here one of these days. But for now, I'm thankful for that conversation. I hope you enjoyed it as well. By the way, if you like what you heard today and you want to learn more about the technical analysis tools we talked about, the importance of relative strength, how to be less of a trader and more of a trender, and how to reflect on the evidence that the market's providing back to us, our Market Misbehavior Premium memberships may be a great opportunity for you. 3 great benefits to the premium membership. Number 1, a series of virtual courses that will teach you all about technical analysis, behavioral finance, what's happening between your ears in your brain, and why it's causing you to make difficult decisions, or why it's causing the decision-making process to be so challenging, how we can use technical analysis to optimize our decision-making. Second benefit, members-only reports like our weekly flight plan and our monthly chart review. As John was saying in today's interview, it's important to take a zoom out and focus on longer-term trends. That's what we do in our weekly and monthly routines, and we share all the results with you every time. Finally, you'll have access to our members-only community where you can ask questions, where you can learn from other like-minded investors, and have a supportive community with which you can navigate markets in volatile times. For more information, go to marketmisbehavior.com/premium. Don't forget to use the code PODCAST when you check out for 30% off your first 12 months on any plan. That's it for today. Thanks so much for joining me here on the Market Misbehavior Podcast. If you have suggestions on who else we could interview as part of this podcast series, wherever you're listening to this, drop a comment and let us know, particularly on our YouTube channel. It's where we get a lot of great suggestions and comments. We'd appreciate your feedback on the show and any suggestions on future guests. We would be very open to them as always. For Market Misbehavior, I'm Dave Keller. Have a great one. And remember, it's always a good time to own good charts.